Imagine you own two buildings. In the first, you manufacture auto parts. In the second, you lease out apartments to tenants and collect rent checks. Look at this conceptual breakdown. Under International Accounting Standard 40, that apartment building is classified as an investment property. It is real estate held exclusively to earn rentals, for capital appreciation, or both. The auto parts factory falls into a different category. That is owner-occupied property, because you use it in the production of goods or for administrative purposes. Regardless of the category, both properties are initially recorded at their cost, the actual cash paid or fair value given to acquire them. This sorting logic chart maps the boundaries. If you build a property to sell it in the ordinary course of business, it belongs under IAS 2 as inventory. If you hold it for your own use, it goes to IAS 16. But if your goal is rent or capital appreciation, it lands right here under IAS 40. Where a property lands determines how you measure it over time. Placing an asset in the wrong column dictates whether a shift in property value is quietly noted in the footnotes, or if it directly impacts the net income you report to investors. Let's look at this 10-story building. You rent 8 floors out to commercial tenants, but you use the top 2 floors as your corporate headquarters. If you can legally sell those floors separately, you must account for them as separate assets. If you cannot split them, the entire building only qualifies as an investment property if the owner-occupied portion, those top 2 floors, is considered insignificant to the whole. Once a property clears the definition, you measure it initially at cost, including transaction fees. From there, this timeline splits into 2 subsequent measurement paths. You must choose either the steady cost model, depreciating the asset over time, or the fair value model, where the asset's recorded value fluctuates with the market. Here is the critical mechanism of the fair value model. When that property's market value goes up or down, you do not record depreciation. Instead, every gain or loss from a change in fair value is recognized directly in profit or loss for that period. Selecting the fair value model directly ties your company's reported net income to the real estate market. A dip in property values means a direct hit to your bottom line for the year. Moving a property between categories requires a documented change in use. Let's map out a transfer. You own a factory with an initial cost of $1 million and a 20-year useful life. At the end of year 5, you stop manufacturing, move out, and rent it to a tenant. On that exact date, the market says the property has a fair value of $900,000. Step 1 is to calculate the carrying amount up to the transfer date using standard depreciation. $1 million divided by 20 years is $50,000 a year. Over 5 years, that is $250,000 in accumulated depreciation. Your carrying amount is exactly $750,000. Step 2. We compare our $750,000 carrying amount to the new $900,000 fair value. We have a gap of $150,000. Now we apply paragraph 61 of IAS 40. Before you cross into the investment property standard, you must settle the books using the old rules. Under IAS 16, an upward revaluation on an owner-occupied property goes into equity. We record that $150,000 gain as a credit to the revaluation surplus in other comprehensive income. Let's test this mechanism. Pause the video and calculate what happens if the fair value at the end of year 5 was only $600,000 instead of $900,000. Your carrying amount is still $750,000, but the fair value drops to $600,000. Under the old IAS 16 rules, a decrease of $150,000 is an impairment. That loss goes directly to profit or loss, skipping equity entirely. Navigating property transfers requires strict timeline discipline. You calculate and settle the old accounting rules right up to the date of the change in use, and only then do you apply the new standard. Notice the asymmetry when entering IAS 40 from an owner-occupied state. Initial gains park safely in equity, while initial losses hit your income statement. But once that transfer is complete and you are officially using the fair value model under IAS 40, every future swing in value, up or down, hits your profit or loss directly. This decision tree outlines the entire life cycle. Step 1. Identify your intent to rent or hold for capital appreciation. Step 2. Initially measure at cost. Step 3. Choose your subsequent measurement model. And step 4, when transferring, finalize the old standard up to the exact date of change. Take a screenshot of this framework. When you internalize this exact sequence, classifying and measuring properties stops being a guessing game. It becomes a strictly predictable, mechanical process.